Good morning, everybody. This is Patrick MontesDeOca with the VCPMI early bird update for January the 13th, 2021. I apologize for a little bit of delay here. We had some technical issues this morning. Getting right into the market here, gold is trading last at $1858.70, up $14.50. Silver is at $25.54, up about 14 and a half cents. Let me take a look at the Thinkorswim chart here that we use to essentially educate, simulate the trades, and to be able to share this with you, self-directed individuals that are interested in following the methodology of the VCPMI, which I'm using and I'm executing here every day at 7 a.m. Pacific Standard Time. And I've been pretty much doing this live streaming here. And I want to thank again TikToker. Wish everybody in TikToker a happy new year. It's a terrific platform that gives you self-directed individuals the ability to see transparently how an individual like myself, a self-directed trader like myself, is applying this intelligence. I want to make it clear here that what I'm doing here is I'm sharing the artificial intelligence that's provided by the variable changing price momentum indicator. By no means I am trying to tell you how great of a trader that I am or how much money I'm making. It's irrelevant to you as a self-directed individual, how much money I make or how much money my clients make or anything like that. And I don't make a point basically of approaching it that way because it's really irrelevant to you what I do or what anybody else does with regards to the application of this algorithm. Now, if you're watching me in live streaming here, and whether I'm using a simulated account or a real platform, it's irrelevant. For you as a self-directed individual, if you want to simulate the trade to validate the probabilities that we use, it's up to you. If you feel that you understand enough to apply and execute the strategy, by all means, follow the indications and use proper management to manage your own portfolio. We have just completed a book, Mean Reversion Trading, that we're going to be sharing with those that are interested. So if you have any interest at all, just get in contact with TikToker, request a trial of the book. For the first 100, it's going to be free. So it's up to you. And the book basically explains to you the functions that are part of the algorithm and pretty much show you how it's made up in the composition of the algorithm, and also pretty much, how the application has, for the last few years, been pretty successful for us, which is one of the reasons why I'm sharing in this platform, basically, the VCPMI intelligence. Let's jump right into the market here and take a look. And if we see the market trading above the daily average price coming into today is 1852. And that gives us a bullish trend momentum. And this trend momentum has activated 1867 as a target for the rest of the day. The signal by trading above the daily average price, ignited a bullish trend momentum. And this is pretty much what the algorithm does, is that, first of all, it creates a very specific structure of 5 pivot points. We don't use more than 5 pivot points. Within those 5 pivot points, it identifies the average price. And within the average price, it identifies the extreme above the mean or that average price, or below the mean or that average price. And so as a self-directed trader, what I'm looking for is, where is the highest probability to execute a trade? So there are a number of rules that identify when not to trade. Obviously, as a self-directed trader, what you want to do is go in there and trade with the highest probability on your side, or the odds on your side, the highest odds on your side. And what the VCPMI does is it tells you when those trades occur and when not to trade. There is a time when you, as a trader, do nothing, even though you might be in a market. You don't have to be actively trading every day unless there's the opportunity there, obviously. And on a day trade, if you have a day trade plan and you see an opportunity, obviously that's what it's for. The VCPMI identifies day trading, swing trading, and position trading opportunities. And you can use it as a retail trader, self-directed trader, institutional trader, hedger, pension fund manager, home office. It is a probability. It is a mathematical probability model. Beyond giving you the structure within the specific Fibonacci sequence criteria that we use, and the pivot points, the algorithm identifies the mathematical probability where to trade and where not to trade, and it identifies the relative implied volatility of the market to the extreme above, to the extreme below. And so when you take a look at the average price, it has a green color. And that green color identifies the average price. And the algorithm, the artificial algorithm, tells you the average price is used to identify the trend momentum of that trading session. In this case, we're taking a look at the daily structure on the left, and we're taking a look at the average daily price of 1852. And this has ignited and activated the target of 1867 on the day signal. Now, this is the trend momentum. It doesn't mean that in the futures, you have to trade by taking the futures contract. This is a futures contract signal. And that is what we're talking about. How to identify a futures trade for day trading. So the market, as you can see, has been in a pattern trading around the average price daily and also on the weekly. And above the average daily of 1852, we have the monthly target of 1864. Right above that 1864, we have the daily target that we're looking for at 1867. So the signal is in a mixed bag, you might say, because it's giving you contradictory signals. It's trying to resolve the wave patterns and converging the trends, the bearish trends, into the next pattern. And as the price made the low, that we made here of 1828, there is a possibility that this is a secondary low that was made in 2021 after the 1817 was the secondary low after the 1767 low that was made in 2011. And so this signal here activated not only the target above, the level above, but also the average price daily. And by trading above that average price now, it's activating the 1867, target. It went up to a high yesterday of 1864, and you could see, and this was during the Globex session here, which is what I say that most of this activity, if you're trading in the gold market, for whatever reason, happens in the Globex when the U.S. markets are closed. And it's pretty obvious that some of the big players, they try to move the market to their benefit when the U.S. is closed. So you want to take that into consideration in terms of holding a position, a margin in a futures contract overnight. I don't usually do that. If I do, I'm hedged, synthesized, or I use shares or ETFs. And I recommend my traders to do the same, unless you have a deep pocket that you can hold on to a drawdown, which usually is bigger than expected. Coming back to the overnight, obviously, because there's no liquidity. Coming back to the market, you can see the test of this level a couple of times on the 12th, and then we activated this signal at about 10 a.m. yesterday, and pretty much, again, the 1864-67 is the area as the targets. And that's pretty much what we are resolving. But in the meantime, the day trading signal is neutral. And this is how, you can manage your inventory, your swing or your position trade by simply following the extreme levels of the weekly or the monthly, for example, if you're looking to trade long term. One of the things that we do is we take a look at the market on all of the trends, on all of the cycles, and we go all the way into the 9-year cycle. And what it tries to identify is basically the momentum of the market, not as much as the price relationship to its fundamentals, as much as the price relationship to the extreme levels, the extreme mathematical levels that indicate basically above or below, extremes above or extremes below. The reversion to the mean principle is a universal principle that basically things get to extremes above and below. Our emotions can get to an extreme above or an extreme below. Extreme anger, extreme sadness, and we want to find a mean and equilibrium to be, balanced, so to speak. The same thing for the markets. The same thing for pretty much day, midday, and night sequences. So it's a universal law, and what we've done is we've understanding the principles that any energy, which is really what we're talking about, expands and retracts. It expands and retracts. In terms of the market, the values, regardless of the big picture, regardless of the fundamentals, they have an internal mechanism that identifies what I call physical movement of the energy, the physics of the energy, in that it expands and retracts, and that it could expand into an extreme above mathematically, that by the law of the reversion to the mean principle, it will revert back to its average price or to its mean. And depending upon the energy coming down to adjust that, it could go below the mean, and then it goes into the extreme level below the mean. And we wrote a code, and it's been working really well. We've had a fantastic year last year. Our subscribers in my private trading room did very, very well. Those that understand the dynamics of what I'm doing, that understand first of all, that there's no guarantees. And when we talk about probabilities, we don't talk about, 90, 95% guarantees. What I'm identifying here, if you be with me for a while, obviously, is you see the probabilities of the market. The probabilities. What are the probabilities that the market is going to move from the average of 1852 to 1867. Well, you're looking at standard deviation to the relative implied volatility to this mean from cell 1 level. It's a 90% probability that if the signal is activated, that it would revert back to the mean. We haven't yet completed that pattern. We completed the pattern at this level yesterday at 1837, you see, few times. So this is the extreme below the mean, and we are trading at the standard deviation 50-50. Down here, it was 50-90. As we move into the mean, it's 50-50. Now, as the market moves above, and it activated above the mean, the signal, by trading above the average price, it's moving up into that 50-90 at the extreme above the mean, relative implied volatility, where you want to see the relationship in the synergy of the price to see the trigger point. So in terms of identifying the trades, for example, the market coming back down to this buy one level yesterday of 1839 was about a 90% probability that it's going to revert back to the mean. As you can see here, it did. Not only to the daily mean, but to the monthly mean that we've been working with since the beginning of the month of this month, which is 1864. Now, what do we do moving forward from here, right? That's the key. That's the million-dollar question. Since we are in a neutral to bullish mode daily and a neutral to bearish mode monthly, we have a little bit of a mixed signal. And even if we get up above 1864, that would activate a monthly bullish trend momentum. This monthly bullish trend momentum is moving into the distribution area of supply daily of 1867 and 1880. So what the algorithm has done is it has clearly identified for us exactly where the mathematical probabilities of a reversion to the mean is to unfold. So we have that perspective look. Now, what will determine where the market wants to go is the market. It's as simple as that. And what is the market? The market is basically the exchange of the supply and demand. In this case, we're talking about the supply and demand day trading in the futures contract, that if we get a close above 1884, we're going to be breaking out on the monthly bullish trend momentum, entering an area of distribution or expectation of supply from 1867 to 1880. Now, the weekly average price is right above 1880. 1880 matches 1880, which is the daily so far. So this is identifying the harmonic relationship right here. And I'll tell you this, if we get through 1880, if the market has enough demand to take the supply that's being offered, and that's what we're talking about. If the selling pressure is weaker than the demand down here, and we get through this level here of 1880, we're off to the races. There's hardly anything above that market all the way up to 1932. And so then you're looking at 1932 to 2015, which is a real possibility if we get through 1880. That's about 20 cents from where we are. And before, obviously, we get through that level, we got to meet the shorter term targets that I'm pointing out to you here, that is defined by the VCPMI. It's a very clear mathematical map that you can use to manage your inventory. That's another discussion in terms of, how do I manage this intelligence? Well, there are different ways: day trading, futures, swing trading, position trading. There are thousands of instruments in the sector. If you focusing on the sector, which I am, because obviously of this tremendous fundamentals that we're dealing with right now, broken economy, political uncertainty, civil unrest, health issues. And there's still a lot of economic chaos to be resolved. Inflation is on the horizon. If you take a look at the grains, and I've been tracking soybeans since March, and boy, we got up to 1436. $1436.50. Wow, unbelievable. And just before, on March, we were looking at about $8 a bushel. So we're, what this means basically is that inflation is upon us, ladies and gentlemen. Don't let the Fed figures confuse you that we have no inflation, it's under 2%, and if you go to shadowstats.com, you're going to take a look at the real indicators, I believe, which include, the real different areas that make up the economy that are extremely important that you got to take into account. You can't disregard some of the basic sectors, like food or energy, if you want to take a look at the real picture. So let me come back here. Let's do a little bit of trading here in the market. And, and again, because we have a neutral position, I'm able to spend a little time here coaching and teaching. But I want to point out to you, coming back here to the middle, that I think that very possible that we can get through that 1880, and we're going to be off to the races, as I said. And it could be that we see this move up all the way to 2015 in a short amount of time. This is like air up here. We get through 1880. The challenge is 1962, which was the high that we saw just last week before the market, dropped to 1817. That was in a matter of, you're looking at from January the 6th, trading 1962 to, in 4 days, it dropped all the way down to 1817. That's almost $150 move. Now, this is what I've been saying here to you guys, that you want to be careful about the volatility in this gold market. It's going to get more volatile. And I don't believe that the gold market has priced in yet the spread relationship to Bitcoin, the spread relationship even to the stock market. I think that in a market spread relationship is completely oversold, which means basically that the opportunity lies ahead here, and the risk basically is great in the equity markets. Although the equity markets, the E-mini continues to challenge pretty much this crisis that we're dealing with right now by making new highs here. But it's very vulnerable, particularly to the U.S. dollar, in relation to the U.S. dollar. So I think we have, number one, civil unrest in the making. We're not sure what's going to happen here with these patriots intending to disrupt the Capitol and pretty much violate a constitution. And we are still feeling the pressure of the lockdown economically. So, one of the things that I kind of been looking at in the gold market, it's in a way, it's kind of frustrating, because you expect or you think that the market should react in a certain way. Particularly last week when we saw this civil unrest in Washington, which was the first time in the history of this country that this is happening. The gold market was yawning, and in fact, it dropped almost $150. Nothing's changed fundamentally. In fact, it's getting worse. And so, one of the reasons why that occurs is because there is a lot bigger money that can move these markets, $100 or $200 in the short term. And that's usually the short side of the market, the players, the commercials, the central banks, that they see the opportunity and trade against the sentiment of the market. And, coming into this year, the sentiment in gold was extremely bullish. Everybody was bullish. And the market is testing that sentiment, trading against it, testing it. but coming down to levels in the market where mathematically, technically, they provide a map, and that's what I use. Eliminate the emotion of whatever sentiment out there you hear, or whatever commentary you hear politically or on the internet, and just look at the market price, and it'll tell you exactly what it wants to do. And once you define that, obviously, then you can intelligently create the inventory for you according to your profile that you want to manage in this sector. And the gold futures contract is just one instrument that you can get involved with. You have stocks, you have ETFs, you have options, leaps, and there's thousands of opportunities besides trading in the futures markets. So I trade in the futures, primarily gold, silver, the mini, and I'm trading more actively in Bitcoin through GBTC. And frankly, that's that's as far as I think I can humanly control. But we do watch, pretty much thousands of markets through the algorithm, through the VCPMI. And so in terms of trading, trading is I believe, very personal. It's based upon your personality. It's, particularly if you want to day trade, there are certain rules that you want to follow, and so on and so forth. It's pretty much like running a business. You need to do certain things. You need to make sure that, you have your perspective in the right place, and that you don't confuse, day trading with swing trading, with monthly trading, and that you don't trade from an emotional base as opposed to a technical base. And, pretty much in using the VCPMI, I have used the mathematical, you might say, support or indicator that is a lot more accurate than my emotions. So, continue to hold your long positions. You have 3 choices of stops according to your profile: a dollar stop. You have a close below the pivot point of entry, and a close at the end of the day, depending upon your profile. My next target, as I pointed out earlier here to review, is 1880. I want to see what it does when it gets up there. Okay, so in the meantime, thank you again for the opportunity to share this with you. And I really hope that, again, every day you come here, you're becoming a better trader. Take care of yourself, each other. I'll talk to you soon. Be well.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John Najarian here with Steve Collegian, co-founder